We're live, our first live stream podcast. I'm Josh Mettle. I'm here today with Jerry Fetta. Jerry gave away his first business to a colleague and restarted with literally nothing before founding Wealth DynamX, which is a wealth creation firm. We are going to dig into that. And it helps clients across the US and around the world build wealth. Jerry helps make finances simple, true, and applicable. Jerry's married to his wife and business partner, Lexi, and together they have achieved financial independence of their own in their own lives before they were 30. And they want to help as many families as they can do the same, which is very similar to my just cause that Jerry and I just talked about. So Jerry, welcome to the show, brother. I'm excited to have you. I love yours and Lexi's mission. I'm grateful for what you're doing for communities around the country. Let's start with this giving away your first business. Bring us up to speed with what that's all about and what you and Lexi are doing today, man.
Awesome. Thanks, Josh. Good to be on today. Yeah. So I guess, with that business that I gave away, I like to say that I was a mainstream financial advisor. So I started that at 18. I was doing, retirement planning and mutual funds and the whole gambit. I refer to it as the soup of the day. And so I was doing that. I was working with Dave Ramsey in several different states. And at a certain point, I started learning more about money, which is funny because I had all these licenses, right? So I had, knowledge, but I wouldn't say that I had real financial literacy. I could just regurgitate information that, FINRA and the SEC wanted me to know. And so as I started learning about real financial literacy, I started realizing what I had wasn't financial literacy, and those were just retail financial products. And I kind of lost the passion for that business. I was like, I don't want to just be peddling products. I need to be doing something that actually helps. So I gave that business away in 2016. No idea what I was going to do. I just knew that I needed, something that I could believe in and I knew would actually help people. And that's when I started to slowly piece together a Wealth DynamX. And it's been, an evolution of adding one step and the next step and the next step. And today we have an entire blueprint someone can follow to go from that first step all the way through to, achieving financial independence.
So you've been working with Wealth DynamX for about 6 years, it sounds like. And just out of pure curiosity, when did you and Lexi get married?
We got married in 2012.
Okay. So she was a partner for this thing and building it with you from the beginning.
Yeah. I mean, when I first got started, I was terrible at business. I didn't know sales, prospecting, marketing, none of that stuff. So she had a job that paid our bills while I failed miserably at being an entrepreneur for several years. And then finally I made enough money to hire her out of that job. She was my first hire. And I was like, hey, let's get you out of that job into the business. And when I did that, we just took off. It was just light speed at that point.
I love it. It reminds me of, the growth mindset, right? When we start off as entrepreneurs, we just have to have a belief that we don't know how to do it yet, but we can figure it out. And slowly but surely, through little failures and little successes, we find that path. But there's a little nugget you dropped right there, which was the precursor for entrepreneurialism, is the ability to have a growth mindset and to approach things that you didn't know. I think, as you said, fail miserably. As you approach those things that you were failing miserably at, instead of saying, oh, this sucks, I'm terrible. It's like, all right, well, I obviously haven't learned that yet. Let's keep going. And now I'm going to learn that lesson next time.
Yeah. And we were talking a little bit before the show. I think you and I had similar childhoods where I kind of started in that. I grew up in that kind of thing. So there wasn't like, there was nothing I was losing by failing. It was like, well, this has been the last 22 years of my life anyways. So what else could happen? It's only up from here.
I always seem to be able to find the bottom and bounce. So let's just keep doing that until we really find the path.
Exactly. Yep.
I love it, dude. I love it. Well, that's a great story and really a cool why, if you will, why you made that shift. So let's get into something that has really kind of caught my attention from a few of my friends that I've been talking to lately. And I have a lot of concern about this. This is something that I've been thinking a lot about, and I'm not exactly sure. I want to hear your thoughts on it because I'm not exactly sure how to advise some of my friends. So I'm seeing investors, people that I know and care for, taking big risks in the market right now. I'm talking about meme stocks, cryptos, NFT, irrational exuberance in terms of tech valuations of some of those companies, you name it. It's lots of risk, no definitive exit strategy, and little to no regard to position sizing. So what are your thoughts on that? And what are your advice? How would you advise somebody that has, potentially had some really successful investments during this kind of crazy, what I'll call everything bubble environment we've been in, but now doesn't really have a plan or for an exit plan, nor do they really have any kind of position sizing set up?
Yeah, it's a great question. And it's something I've talked about a lot, even in the last week. Crypto and that whole market came way down. I posted a couple times on Facebook about it. Not even things that were, untrue, is just true things about that kind of a market. And I think on one of them, I had like 100 something comments of people defending why they were in it. And I didn't ask them to defend. I didn't even, accuse them of anything. They just voluntarily start defending why they're doing it. So, and I've never seen that with an asset class. If I were to post and say, real estate's dumb, don't get involved, none of the real estate investors would comment. They would just think I was dumb and probably not say anything, because they're like, all right, you keep thinking that, buddy, we're going to keep buying cash flowing properties. So I've never seen this phenomena of people rushing to aid, this investment idea publicly the way that I've seen with crypto. I think, the basis of this rests in, a couple of things. The main one for me is the misunderstanding of what an investment is versus a speculation. Okay. So an investment for me, it's got to have track record. It's got to be something that, nothing is guaranteed, but I can look at a balance sheet. I can look at a financial statement. I can look at a cash flow statement. I can look at an underlying asset, and I have some semblance of security and proof that there's going to be production or yield or growth. Right. And so that's what an investment would be. My mindset with investing always has been, if it's not going to be a 5-year deal, don't get into it in the first place. So it is a little bit of a longer term mindset versus speculating, which is not even a bad word. I think people hear that word speculating and they think they're being accused of doing something wrong. Speculating means that, I'm buying something and I'm hoping that I can buy it, low, and I'm hoping that it goes high. And then I'm hoping I can find someone else to sell it to at that price, regardless of what it produces, what it's backed by, who it is I'm selling it to, or how long I hold it for. So, it's a main difference between those two things. Crypto is a speculation. NFTs are a speculation. Overvalued tech stocks are a speculation. And the thing that they all have in common is they're relatively new. They're in a changing space, right? There's lots of change that's been happening and going to happen. And they're also not backed by anything. There's not an earnings, there's not, the assets of a business. There's none of that. There's no property behind it. So those are all the things I see. And so when I look at this, I think a lot of people, there's really a couple groups that I look at. A lot of people fall into the group of, they're frustrated that they're not earning enough income. And so this is what they see as the ticket, right? We've spent 5 and 6 figures on student loans that didn't pan out. We've been at the same job making 50, 60 grand a year. Inflation happens. Now all of a sudden we can't make our ends meet anymore. And so they're looking for the life raft, and they're seeing crypto as the life raft. I actually had a guy that, was pretty rude to me in the comments on my Facebook that day. He emailed me and he's like, hey, you're right. I don't know how to increase my income. That's why I'm speculating. So there's that group. There's also the group, same guys that are going to scratch lottery tickets and the get rich quick crowd. And then there's also, the ultra wealthy that they get involved in these things for sport. They're going to put money into this. They've got tons of other assets. And so if they lose everything in crypto on what they've invested, it's a very small percentage of their net worth.
Yeah, I think that's very true. I wrote down a couple of things when you were talking, and tell me if this lands for you. When we think about speculation, at least it's true for me. When I speculate on an investment, it has a high correlation to emotion. Like I get really excited, when I hear about the incredible gains in AMC or the incredible gains of crypto, I get like butterflies, like I'm going on a first date or something, I get excited. And that's usually not a good tell of an investment. When we're talking about an investment, I'm thinking about the last retail building that my mom and my business partner and a bunch of our investors bought. I didn't have butterflies. I had a headache because I was looking through so much data And we were, we were crunching cash flow, and are we going to get a 30-year AM or a 25-year AM? And what are we not thinking about? And what is the definition of a triple net lease? Does that really mean they pay anything? Like, who pays the taxes? So that may be a tell for people, like to in their minds, to get the difference between investment and speculation. Mm-hmm. Investment has track record, performance, and analytics. Like, you could forecast off the way that property is likely to perform, give or take local market fluctuations, what have you, the economy. But speculation is more heart and emotion. Does that land for you?
That does. Yeah. And I think in the analytics part, especially because on a, on a stock or a crypto, people will look at the trading price of the asset as the analytics. And if we take that same concept and we bring that back to real estate, when you're buying a real estate deal, that's the same thing. You're looking at price, but you're also looking at the sub statistics that are producing that price. And as the investor, you're actually trying to disprove that price. You're trying to show they're listing for too much. I want a discount, and I'm going to use, the profit and losses, balance sheets, track record, whatever, lease contracts to prove that value is not as high as they're saying it is, so I can get a discount. It's not a good thing to buy at a high price in the real estate world.
Mm-hmm. Yeah, that's super, super interesting. The other thing you said was, on investments, you like to look at a minimum of 5 years. We, in the mortgage space, we talk a lot to people and say, the longer your time horizon, the lower your risk. If you've got to be, if you're going to do a medical residency and you're there for 3 years and you're going to bounce and you're going to need to sell that property because maybe you're going to another fellowship that doesn't have a really high income, so you're going to need that capital back. That has a lot more risk than if you're going residency into an attending physician role and your income's going to go way up, and you can just turn that into a cash flow producing property and hold it for 10, 15 years. It's not going to hurt you. So it's interesting you said 5 years. When I think about our investment philosophy, we talk about the preferred holding time of a real estate investment, thinking of 100 years. I'm always thinking, are my kids going to be proud to own this piece of property? And can my wife and mom go to this property without getting mugged? Those are kind of like my litmus tests. If they don't pass those two, I'm like, nope, next. No need to do the due diligence on the underwriting, right? Let's just pass and go to the next one. So cool. I love that. Those are really good nuggets. And I love the long-term time horizon as the differentiation between investments and speculation. That was really great.
Yeah.
So were you going to say something else there, Jerry?
No, I was just, agreeing with you. Yeah.
Okay. So let's say that you're in these investments. Let's say you've gotten yourself the majority of your wealth, or let's just say maybe more than what you realize you're comfortable with, into these highly speculative meme stocks, different cryptocurrencies, NFTs. What would you suggest somebody does in terms of kind of analyzing their position sizing or analyzing their exit strategy? Because it's easy to get in, it's a lot harder to get out, and it's a lot harder to set position sizing, which, as you know, correlates directly to risk.
Yeah. So if someone's in these already and they realize like, hey, I'm in too deep, or even they're not in too deep, they just went to the price where they want to sell. The first thing that most people don't think about is taxes, right? Unfortunately, a lot of investors, and if we can call them that, I would say it's more, speculators that get into this type of thing have never had any sort of experience with real investing. They've never bought something that went up in value and then sold and exited. When you sell that is a taxable event. Okay. So this entire idea that it's off grid and privatized, no, the government knows you sold. And if you don't pay them their taxes, you get charged penalties, fines, and possibly go to jail. You don't want to be like Willie Nelson, right? So that's the first thing, is you want to be able to predict, what is my tax liability going to be on this? And is there a way that I can mitigate that? And real estate, you could do an exchange, right, where you can roll it into another property. With cryptos and stocks, you don't really have that same ability the way you would with real estate. So you've got to either look at, what's my tax bill? Do I have the liquidity and the cash to pay that? And if not, like, what am I going to do? Because otherwise I've got to hold it, or I've got to figure out how to write off against it. That's the first thing. The other thing is, if I'm not quite sure, I just bought it because, it looked good and now it's time to sell. I've got to look at, okay, well, what's the market like? Am I making money or not? It might be a thing where if I've got the tax strategy, I sell everything out all at once and I get back into cash. And then from there, I can regather and get into another asset. It might be another thing where I have to dollar cost average my way out of it, where I sell periodically because the market's moving and I don't know where it's going to be. So I can at least get the best average sale price instead of, going for a home run swing where I might make it, I might miss it. And it might even be because of a tax reason. It might be cheaper for me to sell it over a period of time because that stretches my tax bill out, right? So those are some things I would consider. Once you're in cash, I don't like cash. I don't keep a ton of my holdings in cash, but at least you can pivot then. You can educate and figure out, okay, where do I go now?
Yeah, you bring up a really interesting point there, Jerry. I know it's true for myself that I tend to catch myself thinking in binary ways. In other words, I either have to be all in or I have to be all out. And I've thought of dollar cost averaging in. I haven't thought of dollar cost averaging out. But so the other thing that came up for me was if I say, okay, I've had some wins here. The market seems to be moving another direction. I don't really want to totally exit this position because I still think it's going to rebound, but I'm not as sure as I was when, now it's at 70. I'm not as sure now as it was when I bought it at 15. So You don't have to sell the whole thing. Like you said, you can dollar cost average out, which I'd love you to just touch on one more time for me, because I don't really understand. I think there's more to that than what I understand. But then you could also take half of the chips off the table. When we talk about position sizing, if we realize something has upper limits in terms of its risk, then we want to have a smaller position. Where people get really in trouble is they have a big position and it's high risk, and that really cuts. So if you've had some good gains, you don't have to take all your chips off the table, just take some out. Talk to me a little bit more about that dollar averaging out of an investment.
Yeah, that's basically, you would look at, if I have a chunk in there, I would look at my time horizon and say, okay, well, at what period do I want to be out to whatever the full completion rate of what that means to me? If it's 100% or 50%. And if I don't want to take it all today, I would literally take the amount that I want to withdraw over the time period that I want to take it out, and I did divide it by that time period. And what that does is, regardless of price, that mode, whether that's monthly or quarterly or weekly, I'm pulling out X amount of dollars from my crypto portfolio. And what that means is, as the market moves, I'm just going out anyways. And so when you dollar cost average, you're not always getting the best price that day, but you're averaging it out. And so this would be a good strategy for somebody that doesn't know how to time it, isn't sure, and does want to get out securely. The other thing you can do as well is, depending on, and you have to get with your CPA, depending on your tax treatment, is you can pull out just your basis, just your principal, right? Your principal, periodically, if you pull that out, it's already been taxed. That's not money that they can tax a second time. So if you're structured correctly and you just withdraw your principal and none of your gains, then you can get out and avoid the taxes. And then you can just leave your gains in there growing. At some point, you will pay taxes on those, but it kind of gives you some breathing space.
You're playing with house money at that point, right? Because you got your basis back, your initial capital, and now you're playing with the house's money. I love that. So here's what I wanted to mention about dollar cost averaging. When I found myself starting to invest in crypto, which by the way, I listened to a whole bunch of research. I thought this is absolutely fascinating. In some way, I believe the blockchain is going to change the way we transact and do business. And it seems like currency has a probability of going along for the ride. And so here's what I found myself doing. All this positive podcasts on cryptocurrency, everything's roses, prices at the high, Josh is buying cryptocurrency. Then everything goes down. It's a bottom. Everybody's capitulating. And I'm like, oh no, I should probably sell my cryptocurrency. But at least I didn't sell. I just hung on to it. And then speculation would go up. All the podcasts would turn rosy and I'd buy back in the high. So I did that about 3 times and I went, I'm terrible at this. Like, I'm really bad at, I am such an emotional buyer. And I said, okay, here's what I'm going to do. I'm going to take the amount of money that I want to earmark for cryptocurrency for a year. And I had an intentional plan that once I get X percentage of my overall net worth, I'm not buying any more cryptocurrency. So that was my position sizing. And that also became my exit strategy, because when my holdings exceed that, then I'm going to back out of that money. Like you said, I'm going to take the house money off the table as it exceeds that percentage of my assets. And I'm just going to dollar cost average in every single day, a small amount, or every week into that cryptocurrency. And what I found was, instead of just emotionally buying on the peaks, I was buying at about the halfway mark, right? Because I buy on the down days, I buy on the up days, and so it would do the same thing on dollar cost averaging out, I assume. It takes the emotion out of it, and it just gets you to the result that you want.
Yeah, absolutely. And with crypto, when you're speculating, there's the old quote of fear and greed, right? So when people are being greedy, that's when you want to be fearful, and when people are being fearful, that's when you want to be greedy. So you almost want to do what you were saying. You want to do opposite of that, where when the podcasts are rosy, don't buy a thing, right? Yep. Like that's when all the other money is getting, and it's called market displacement. More people get in the pool, the water rises. You don't want to be in the pool when everyone and their kids are in the pool, right? Yeah. Once they get out, that water comes back down. Now I'm going to go swimming, right? So that's kind of the way you'd want to go. And again, I don't speculate much myself. So that would be the theory behind it. It does take some very, very strong discipline and practical application to do that, regardless of emotion and distraction and advice and all these things that can come into your mind at the time to pull the trigger.
Yeah, well said, man. Well, I think we covered that very well. I appreciate your advice, and you taught me a couple of things there. So thanks for that.
Absolutely.
You have a step-by-step sequence to build wealth like the top 1%. I loved that headline, and I'd love you to dive into that and talk about what you have observed around the top 1% and how they accumulate assets and how they live their financial lives, and then help us understand what that step-by-step sequence is.
Absolutely. So yeah, so I wrote a book about it. It's called Blueprint to Financial Freedom. And so basically this kind of outlines this. And so you guys can grab a free chapter of that too, if you go to jerryfetta.com/free chapter. But basically when I was a financial advisor, I learned all of this, like I said, mainstream stuff. And it was all of the things that, basically the government wanted me to learn and be able to regurgitate about stocks and bonds and mutual funds and options and all these different things. And when I started learning about, the top 1%, it was around that time where I realized that there was other things out there, right? And what I really learned is the top 1% aren't out there buying mutual funds. That's not what they invest in. They're not into retail financial products. And so then the question opened up of, well, what are they into? And I couldn't find that answer. And in the financial advising world, when you ask those type of questions to the company I was with, I got slapped on the wrist so many times. Don't ask that. We can't talk about that. You can't tell people about that. So I had to go out and do my own research. And so what I did is I call it reading about old dead guys, right? So I just, found as many biographies as I could of John Rockefeller, JP Morgan, Andrew Carnegie, the Rothschilds, all of these groups that I knew for sure had wealth. And I started studying, well, what did they actually do? Right. And so it was very interesting to see that, what they actually did was very simple. And so the first thing is most of them, they had a large degree of financial literacy, and it's not hype phrases and motivational stuff. Like John Rockefeller was an accountant. And so that's a strong financial literacy base to be able to look at, a profit or loss, a balance sheet, and be able to read it as an accountant. And so that was one thing that I picked up, as every single one of them did. JP Morgan was a banker. Right. His dad was a banker. He spent his time with bankers. And so he had, from the age of 16 years old, he was learning banking lingo. And that's something that I think gets overlooked, because we don't get taught finances in school. If we did, it would be very basic, like how do you balance a budget and basic things. I'm saying these guys were learning things you would probably learn today in college, and they were learning them as teenagers. And sometimes it was mom and dad enforcing it. Sometimes it was just that's what they wanted to know and to learn about. That's what they were into. So that's where I started. And as I started to then learn, okay, well, they get the knowledge. What do they do then? I realized that they invest in hard assets. They're investing in real estate. They're investing in gold and silver. They're investing in small businesses, like actual, not large publicly traded companies, but almost more of like a venture capitalism type setup. They're investing heavily actually in whole life insurance. That was one that surprised me. And so I started looking at these things and seeing, okay, well, they earn lots of income. They have lots of financial literacy. They're very solvent. Like they have, a lot of assets, not many liabilities, maybe with the exception of JP Morgan. He was a banker. So assets and liabilities switch at that point. And then they basically invest for passive income. right? And so, there's a story with John Rockefeller. When he retired from Standard Oil, his net worth and his wealth grew exponentially more than when he was working at Standard Oil as the CEO, right? So when he was running his own business, sure, he was wealthy. He was still the top guy. But I'm saying when he left his business and focused full time on, he called it his family office, his investment portfolio, his wealth just snowballed, right? And so he had enough passive income to buy himself out of, arguably the highest paying job in the country at that point. CEO of Standard Oil, it doesn't get higher than that in the early 1900s. And he got himself out and built wealth that way. So that was big. The other thing that was big was they all had, like you said, the 100-year mindset, the legacy, right? Rockefeller was thinking, 3 or 4 generations down the road. The result of that is Rockefeller Family Trust, 3 or 4 generations down the road, still has hundreds of millions of dollars paying out to beneficiaries. Carnegie was one where he thought with the end in mind too. He said, I want to die broke. Not because he squandered it. He literally gave everything away. So that's another one where he didn't have, the family legacy like some people will, but he was like, well, my churches, my charities, my organizations, that's why I'm doing this. And so with the end in mind, I'm building for that purpose. And so that was another thing that I noticed the top 1% do is they think about, okay, what is this going to look like after I'm gone?
I love it. So I took down some notes. I want to make sure I got these down right. So number one, they have a high degree of financial literacy. Number two, they invest in hard assets like real estate, businesses, gold and silver. And when you say businesses, you're not talking about buying stocks. You're actually talking about whole ownership of businesses, similar to like what Warren Buffett really did a lot of, or would like to do a lot of if he could get a decent price. Invest for passive income and have a generational or 100-year mindset for your investments. Was that the 4 steps?
Yeah, that's the gist of it. Yeah.
Great. All 4 of those resonate with me very, very highly. One of the things that I know in my businesses, which are all around, I'm talking about my real estate investment businesses. We do some private money lending businesses. When we started being disciplined around looking at a P&L statement every single month, whether we liked it or not, we gained tremendous insight into our businesses. And so, I didn't necessarily learn that as a teenager, but as a property owner, the more I would intentionally set time to review those financials, I would make better business decisions left and right. And it also helped me evaluate other properties that we wanted to buy a lot better because I've been evaluating what my apartment building's P&Ls look like. And I could spot, whoa, that doesn't look right. Let's
standard of comparison.
Yeah, let's dig deeper here. So that is absolutely a catalyst in terms of our growth. Obviously, invest in hard assets. That registers for me. Robert Kiyosaki, is famous for saying, I think this was in Rich Dad Poor Dad. He said, look, if it doesn't have a cash flow, it's not an asset. Period. It's either draining money from your budget or it's adding money to your budget, which you can then take and make other investments that create more cash flow. That's it. So that's really interesting. That lands. And then of course, have the multi-generational 100-year mindset. I'm going to drop this in the chat here for everybody too. That was great. I love that. Wonderful. Well, thanks for sharing that. So you actually help your clients essentially take on that mindset of these billionaires that you studied.
Yeah. And it's something that I started with first, right? So, as I started to follow like this type of investment strategy and financial strategy, what I saw that was really different, Josh, is it was cause and effect, right? Where I would do something and then I was told, you do this, this is what will happen. And then sure enough, that's what would happen. And I wasn't used to that in the retail financial world mainstream. We're trained to tell people past performance does not mean future performance. You can't guarantee anything. You can't make promissory statements. So I was coming from a world that, my expectation was very shifted towards, well, maybe this will work. Maybe it won't. I can't promise anything. I don't know. And then it went into, okay, well, this is what you do. And this is what will happen no matter what. And that's what was happening for me. So I was able to build it out myself following that method and system. Now it's something that I'm able to help clients do as well through, our system of the blueprint and working with them on a personal financial basis. And, it's step by step. It's, gaining financial literacy. It's building solvency. then it's starting to build financial freedom through investing, and it just kind of snowballs at that point.
I love it. So this is a perfect transition. And the next thing I wanted to ask you about, and you've obviously already alluded to it a little bit, but I want to know, what are you doing with your money right now? How are you looking at real estate valuations? How are you looking at gold and silver? Are you evaluating buying other businesses or just investing heavily in your own? Like, what are you doing with your own capital? You mentioned that you don't like to hold a lot of dollars. So where's that life energy going, Jerry?
Yeah, so I am big on a couple of things. So, I have this thing called the triangle of wealth. And it's basically, if you look at the triangle, it's earn, save, invest. We earn in currency, we save in stores of value, and then we invest in income producing assets. So, at any given time, I'm working on all three of those points, growing my business, growing my earned income. And that's the trick, is it takes earned income to get passive income. A lot of people don't realize that. You will put in the work for 5 or 10 or 15 years earning so that you can get the passive income. So I'm right there with you, right? So the trading time for money thing will still happen. You just have to get really good at it so that you're uber efficient with the amount you're getting per unit of time traded until you can buy your way out. So for me, as the store of value, I do gold, and I do high early cash value whole life insurance. So when I earn my currency, I only keep 1 month in cash. Like literally for my business and personal, it's 1 month in cash, enough for some liquidity, right? Bills have to get paid, settled, et cetera. Everything else comes off the table, and it immediately goes into gold and life insurance. And the strategy there is those assets are going to grow and appreciate. And as I'm ready to then put them to work and deploy them into assets, I can actually borrow against them tax-free. When I borrow against them, they still grow, right? So life insurance is going to grow at about a 3 to 5% annual rate. Gold, historically, since the 70s, when we were allowed to own it again, about 8 to 10%, right? So I'm going to have this positive arbitrage spread on what I'm earning and what I'm paying. Then I can also deploy the capital and earn another rate of return. I'm very big on private lending. So I don't like landlording and dealing with tenants and properties. So I'm the mortgage on lots of real estate. And so I'll find a deal or an investor or a fund that I have, worked with in the past, has credibility. I'll loan to them as, first position security on whatever it is they're doing. And then I just get interest checks every month. And so that's kind of the way that I go about it. I like that because regardless of the market, people need loans. This being in the mortgage world, people need money, man. So if the market's down, they need to borrow money. If the market's up, they need to borrow money. As long as they repay me, I'm fine. And if they don't, I get to take away their thing based on, the contract or the paperwork. And so that gives me some downside protection.
Yeah. And you're following the third rule of money from not Think and Grow Rich, from Richest Man in Babylon, which is make thy gold multiply. Invest wisely. We got to get that cash flow. So there's a couple of things that you said I want to dug into. You said arbitrage. I want to define that and talk about that because I think that's a really important concept in currency. But I don't think I got all three of the three sides of the triangle. The first one was earn in currency. Will you give me the other two a little slower?
Yeah. So earn in currency. And then we have save in stores of value.
Got it.
And then we have invest in income producing assets.
And invest in cash flow producing. So walk me through that waterfall, Jerry. Money comes in, it automatically, probably, I'm assuming there's some sort of automation that automatically sends that money into a pre-decided decision to buy gold. Is that physical gold? Is it bullion? Is it miners? Is it a combination of?
Physical, yeah, physical generic bullion. So I don't get involved in, if it's digits and paper, it's not the real thing. So I get the real deal.
No counterparty risk, baby.
Exactly.
All right. So it goes straight into gold. It goes straight into life insurance. And then you then borrow from that to invest in a note, a private note. And then you're probably earning the arbitrage between what your borrowing cost is against your asset and the cash flow that you're bringing off the note. Did I get that right?
Precisely. And then both of those assets, gold and life insurance, are also still growing at the same time.
Right. So you've got the double. So when we go into this asset bubble where everything's growing, you're getting the growth and the cash flow. That's really super interesting. It's not far off what I do, interestingly enough. So my money comes into my checking account. I beg my wife if I can have some. Then I move that money immediately over into, I've got 3 different buckets, but it's essentially gold, I do some super diversified ETFs that are all over the place. I do a little bit of cryptocurrency. And then when I need capital for a real estate investment or a private money note, I'm way heavier real estate than note, because I have a family and a team that's willing to manage that real estate for us. Then I either borrow, which is my first choice, margin loans, take that money out if I can, or if I have to, I'll liquidate and then make the real estate investment, because that's kind of like my primary play. I go back to the Kiyosaki thing. If it doesn't cash flow, it's not an asset. So the gold and the ETFs is like, I know I'm going to do better than if my money just sits in cash and I have inflation eat me to death.
Yeah. Yeah. And that's the thing is inflation this year, so if you look back, CPI, Consumer Price Index, that's what we're told inflation is. If you look at that in reality of what actual inflation is based on like the 1970s and 80s calculations, real inflation is about double what they tell us it is on CPI. So this year, when they say it's 7 or 8%, it's actually like 14 to 15%, which means if I had $100,000 last year, this year, that $100,000 buys only $85,000 worth of things. So, and that's why you said it, not keeping a ton in cash. I said the same thing. I only keep a month in cash. It's a negative rate of return. You're losing the longer you hold the cash. It's the definition of that game, hot potato. You don't want to hold on to the cash.
Yes. So the two things that and I'm glad you brought up inflation, because that was the second thing I wanted to circle back on. Let's go back to this idea of arbitrage real quick, Jerry, because we both described it and we're both using it in very similar fashions. But, there is that traditional school of thought, the Dave Ramsey school of thought, where you have to pay off all debt before you invest. And that is a route to reaching financial freedom. But if you listen to somebody like a Kiyosaki or somebody else like that, they'll say, no, loans are leverage. If you're using leverage to put you into an asset that is going to create greater cash flow than what the cost of the loan is, you do that all day long. Because to your point, Jerry, I get the cash flow, which is the difference between the payment and what the net rental income is. I also get the growth of the asset, the principal growth. So help us make arbitrage super simple for everybody to understand it, and tell us your thoughts on it.
Yes. So arbitrage is when you have an asset growing at a certain rate, and then you borrow against the cash value of that asset at a lower rate than what you're earning. And you instantly make profit. So it's very different than there's no hope involved. It's not like I'm speculating and I hope I can, buy a stock on margin and it goes up. It's no, this is already earning. I know for a fact I have proof, and this rate mathematically is lower than the earning rate. And I know for sure I'm going to be profitable instantaneously, right? So I could not even invest the capital and I would still make money on just borrowing against the asset. Now, the second step of this is then, like you said, deploying it into something that does produce passive income or cash flow. And so that's kind of the 1-2 step. The third step for me is the income that I get, I service my loan with, right? So if I'm getting, let's say I take 50 grand, I pull that from my life insurance and it's growing at 3% or 5% and it's costing me 2% to borrow. I might put that in a note, and that note might be paying me 12%, which is $500 a month. And I'm paying my cash value back with that $500 a month, which is a form of saving money. Principal reduction is a form of storing value. So it also then replenishes me so I can pull more again out next time.
I do the exact same thing. That's really good. You're corroborating my thought process, which I appreciate. I also like to be challenged, but I love it when somebody else is doing it successfully, and I've figured it out from a different approach. So arbitrage, another way to say that is arbitrage is the delta or difference between the cost of borrowing and the income or rate of return that you're going to get for investing that money. Yeah. And that difference, the delta, is what arbitrage is. And what's interesting is, when it comes to personal finance, the mantra is, the kind of the Dave Ramsey mantra: pay debt, pay debt, pay debt, pay debt, and then invest. But if you look at what Fortune 500 companies do, They borrow, like, look, like, go Google how much money does Apple borrow out of the bond market? Like,
Yeah.
it's, it's hundreds of billions of dollars. And then you're like, well, wait, but they already have like 86, last time I Googled it, $86 billion in cash. So why are they borrowing? Arbitrage. They know that they can get a 20-year bond, a note, if you will. Private people can't borrow bonds. We do mortgages against our assets of our house. They can borrow that at 2 or 3%, and they're going to make 10, 15, 20, whatever their return on capital is. I know you got something to add there, Jerry.
Yeah. And the other factor too, and I don't want to get too into the weeds with Apple, they're headquartered in Ireland. They're in a tax haven. So when they make profit, none of their profits taxable unless they bring it back stateside. So this goes back to, whether it's life insurance or gold or a mortgage. When I do a loan against an asset, a loan is never taxable.
Yeah.
Right. So the cost of interest might also be cheaper than just my taxes. If I were to pay taxes on this money, that's more expensive than my interest. By the way, my interest is also tax deductible. So in that scenario, I could really never pay taxes on the capital I invest and the gains inside that vehicle, as long as I'm always borrowing and then reservicing and borrowing and reservicing.
That's right. You completely escape taxes. And then, hopefully you pass that on to your kids and you get a stepped up basis, and you really kind of just circumvent the entire tax system. Hey, Jerry, we did get a real quick question. You mind if I throw you a question from one of our viewers?
Yeah, go for it.
Cool. He says, how do you know if you're looking too long-term at your investments? And what information do you use to factor out bubbles in the stock you're viewing on the short term? Let me read that again. How do you know if you're looking too long-term at your investments? And what information do you use to factor out bubbles in the stock you're viewing on your short term?
That sounds like two questions. So the first one is on looking too long-term. I would say, if it's stock specifically, I would say that people tend to look at, historical periods and predict that that's what it's going to do in the future. Really, that's not a great, and we kind of covered this early in the show, that's not a great way to go about it. If I was looking at a stock, I would actually be looking at their financial statements and making a valuation based on that. There are mathematical formulas for that. And then I would also be looking at, whatever the asset would be, what is the economy for that asset look like? If it's a stock or real estate or whatever it would be, what are the macro and micro indicators, big picture, small picture indicators of where that particular micro economy will be going in the next, 5, 10, 15, 20 years. Where I think people go wrong with the long-term thing is mostly with retail financial products, where they're like, hey, this mutual fund is done X% over the last 50 years. That means that it's good to invest in. And it's like, well, the last 50 years aren't the next 50 years. It's not going to be the same things. It might not even be here in 50 years. And I think that that's very different than, like Josh said, with a piece of property. Chances are it's going to be here in 50 years. And in the last 50 years, rents have gone up and, population is increased. There's more people than there is land. So appreciation will happen as well. And I think those are all things we have to take into consideration. As far as bubbles, they're going to happen. I think you have to kind of just average that in. If it's an asset you want to own, you should want to own it regardless of price. And that's really where I'm at with my assets, is like, my gold, my life insurance, my notes, regardless of price, I want those things because they're valuable to me and they produce something for me of meaning, rather than just what is the price and can I flip it today?
Yeah, I totally agree with that, man. My mother and I had like 36 or 40 single family homes during the mortgage meltdown. And we, unfortunately, we were in the middle of doing some major renovations, which was very uncomfortable at that moment because, my income was very well displaced. But I got to a place after the initial fear came filtered through where I went, okay, we've got the renovations done. Now we're just in this holding phase. The value's dropping like a rock. And I had this moment where I went, why do I care? Like, I'm bringing in more money than I have going out for the mortgages every month. The value, what somebody is willing to pay for this property right now doesn't matter at all, because I don't want to sell this property right now. Mm-hmm. I just want the cash flow. And so I think that's what you're saying is regardless of what Mr. Market says the valuation is, if you believe in the intrinsic value of that asset of gold, because you got a 5,000 year track history, if you have cash flow coming in from those notes every month, who cares what somebody's willing to pay for them?
Yeah. Yeah. And that's the thing is, markets are all manipulated, right? So it's like you're basing your decisions off of a smoke and mirrors game. And the only time price matters is if you're going to sell or borrow against it. So if you're not going to do either of those things, and even let's say the economy did crash, if I have rentals that I'm either renting out or properties that I'm owner financing out, let's say the dollar doesn't exist anymore, people still need to live there. So I can tell them, hey, rent this month is you need to go kill a deer and bring it to me so I have meat, right? Like there's always gonna be some supply and demand factor.
For sure. Yeah. Love that. Great answer. Okay. One more question I want to ask about inflation real quick. And then there is a question on life insurance. So I'm gonna pitch that to you, and then where people can find you. So we talked about arbitrage. I think that was really interesting. I want to ask you the question of inflation, and if you could speak to, there's two sides of inflation. If you're a lender, inflation cuts one way. If you're a borrower, inflation cuts another way. So could you help explain the difference of how inflation impacts those two different groups?
Yeah. So quickly, we'll define inflation. There's really two sides to it. There's an increase of the money supply. And so that's when more currency is created. I explain it like if I have a glass of or a cup of coffee, right? It's potent. If I dump water in it, it's not potent anymore. There's more in the cup, but it's not going to taste good. It doesn't have the same power. The other side of inflation is actual price increase. If you're an entrepreneur, you've probably had moments where you're like, hey, I need to increase my prices. It wasn't because of any monetary factor of the Fed. You were just like, hey, I'm more valuable, or I'm bringing more to the table. I'm worth more and I can charge more. So I do. And that's really the two different
demand based, right?
Yeah, more of a supply and demand, factor that goes on there. So that's really the two sides to it. Both of those are going to happen. Historically, we can look at inflation and we know that it's usually 6 to 8% as an annual range for the last 100 years on real inflation numbers. If I am a lender, what that means is my currency, and when I loan it out, that currency as it's being repaid is actually buying less and less every month, right? So this is the downside. Like for me, I do a lot of note lending, a lot of mortgage lending. So, if I'm getting, $1,000 a month last year, well, sure, on paper this year, it's still $1,000, but it's only buying me about $850 worth of items, right? Because prices have gone up. So that's the downside. And the way that I offset that is I have to get more loans out there. Right. And it, depending on how interest rates are, I might do that through my margin, raising my rate up on my loans, or I might do that through my volume of just getting more quantity of loans out so I can offset the increase in the inflation. Now, as a borrower, this is a great deal for me because it means that I get to pay Jerry back with devalued money every month. Right. That $1,000, like it still is $1,000. Right. And that's still going to come out of my pocket, but it's buying less and less stuff every month, while I'm getting more and more appreciation on an asset if I did, make a good decision and buy an asset with those funds.
Really well said. Well, what just hit me is you can think of inflation like Robin Hood. Robin Hood takes from the lender, the person who has the wealth, and gives to the debtor because the debt is being devaluated. And I find that people have a hard time seeing both sides of that, probably because they haven't been the lender on that transaction. They've only been on the borrower side. But we do this demonstration, Jerry, where we show the difference in housing price and interest rate and household income. So that's the three things that comprise household affordability: price of the house, which means part of your loan amount, your interest rate, and then your household income. You use the averages from 2006, compare that to the average of 2021. And what's interesting enough is that the house is more affordable. The payment's not lower, but the house is more affordable on a national level because interest rates are 3.5% instead of 6.5%, like they were in 2006, and household income has gone up. So even though the price of the house has gone up, in terms of a relative scale, your debt to income ratio goes down. The proportion of your monthly income is less going out than it was in 2006 at the last peak of the housing market. And I think the reason why I wanted to bring that up was as time goes on and there's inflation, your income will go up. Household income levels will go up, but the payment on that debt every month stays the same. So as a proportion of your household budget, the proportion that goes to service that debt is going down. So you described that perfectly. Thanks for summarizing that for everybody.
Yeah.
Let's jump into this last question here, and then I'll give everybody your contact info and where they can find you. I'm sure they're going to want to learn more from you. Any specific life insurance products you recommend for future self-borrowing?
Yes. So there is one of them, right? And I want to specify it is one kind and is designed a certain way within the myriad of all of the kinds of life insurance that are out there. Okay. So this is going to be a bit of a mouthful, but it's called high early cash value dividend paying whole life insurance. Okay. That's the only kind that I would recommend using for this. And the reason why is this is if you Google bank owned life insurance or corporate owned life insurance, the number one consumer and purchaser of dividend paying whole life insurance in the United States, it's actually banks. Right now, they have almost $200 billion in life insurance cash values. I think Bank of America has like $22 billion in life insurance. And so we're mimicking that strategy. And that strategy is when I put in, just to keep it simple, when I put in $1, immediately 70 to 90% of that dollar should be available in cash value from day one. So the question was future borrowing, which is important and good, but this is actually immediate borrowing, meaning I can deploy capital into it and immediately pull out 70 to 90% of that money. And that initial dollar still compounds tax-free at a 3 to 5% rate, right? So it's an immediate game. Now, the other thing I love on the life insurance is it's not taxable. It's a unilateral contract. So in the finance world, that means only one party can change or affect that contract. That's me, the owner of the contract, right? So even the IRS can't touch it once I put the money in there. It's protected against creditors. So that's another thing is if I've got funds in the cash value, it can't be touched by creditors. And it's also protected against lawsuits. So it's one of the safest places I can put funds. In a bank, they call this tier 1 capital. And that actually is where they store it, is in life insurance. And so that's kind of what I would look at for that.
You know, I am woefully uneducated in life insurance. Let me tell you my initial takeaway from life insurance is that life insurance pays the highest commissions to financial advisors, and it's not good for me. And I would love you to come back another time and tell me more about this and why it's advantageous. And if you'd be so brazen to do so, I'd love to hear like, what does the commission stream for the person that's selling that product on the other side look like? Because I'm okay with paying us for a service if I'm getting an upside, but I would like to know what I'm paying for the service. So give me that again. It's the high early cash value dividend paying
whole life insurance.
Whole life insurance. Okay,
yeah.
Great.
And real quick on the commission thing, to design it this way, Josh, the agent has to be willing to take a 300% hit on their commission.
Wow.
So most agents aren't willing to. And if they were, their manager doesn't want them to know how to do that because it's not profitable for the agency. Right. So there's a little bit of a conflict of interest that you hit on the head, is the agent has to know and also be willing to take a gigantic pay cut to do the right thing.
I'm guessing that's why I've never heard of it before, Jerry.
That's probably why you've never heard of it before.
Dude, you're a stud. I've had a total blast in this conversation. Where can people, and thank you for sharing so generously, like you're a wealth of knowledge. Where can people find you? And could you please tell me again where they can get your book?
Yeah. So again, the book is called Blueprint to Financial Freedom. And if you go to jerryfetta.com/free chapter, you can grab a free chapter of the book there on ebook. And then you can also purchase it there as well. For following me, I'm most active on Instagram. Go to Instagram. It's just at Jerry Fetta. Fetta like the cheese, but with 2 T's because it's twice as good. And I post a ton of content there. So videos, posts, you're going to get a lot of free education. And, if it's something that helps you, follow and connect with us.
I love it, brother. Thanks for joining us. I'd love to invite you back. I'm going to sign off for everybody there watching us on the live stream. And Jerry, if you'll hang for just a second, that'd be great.
Absolutely. Thank you.